So I'm Noah Breslow, the CEO of OnDeck. OnDeck is a company focused on the challenges that small businesses have when accessing capital. And so what we'll do in this presentation is just take you through why small business is an interesting segment to focus on from an alternative lending point of view, why there's a funding gap, if you will, for the smallest of small businesses in America. We'll then talk about how OnDeck's data and technology are enabling innovation and capital to flow kind of in the space. And then we'll finally set up a little bit about how investors can participate in this. We've been running the OnDeck platform now for a long time, 7 years, and we've now developed a number of ways for institutional investors to participate on the platform. And then we'll take some Q&A. We'll run through things pretty quickly. So the one thing I want you to take away from the front part of the presentation is that the small business lending gap in America exists for a number of different reasons. It's not just sort of a single root cause that drives it. 99.7% of businesses are small businesses. These are kind of the backbone of the American economy. They're over 50% of our nation's employment. I think it's 60+% of our GDP. So it's not that there's not a large number of businesses out there when it comes to lending. There's a huge target that you can think about. But if you look at what's happened over the last couple years, since the Great Recession, the number of large business loans, or the volume, I should say, in large business loans has gone up, whereas the volume of small business loans has actually decreased. And this is despite numerous government incentives after the Great Recession to kind of stimulate small business lending. So you can see a 19.1% drop in small business loans since 2007. Now what's interesting is that the business plan for OnDeck was written back in 2006. It was the credit boom. So there was obviously a belief even back at that time that there was a need for a different kind of solution. So when you look at it, there are 28 million small businesses in America. And 7 million of them are what I would call full-time businesses, which means that the business owner is making a living from their business. They have at least $100,000 in annual revenue. 7 million is also the number of businesses that employ at least one person on their payroll. So these are the full-time businesses, if you will. And 5 million of these businesses seek funding annually. We think that OnDeck serves about 4 million of those 5 million businesses. So it's still a massive, massive market. But the interesting thing about the 28 million is many of those folks are treated like consumers. And the interesting thing about small business loans in a banking environment is you're kind of betwixt and between. You're a large-sized consumer if you're a small business, and you use more services in the bank than a typical consumer would. The flip side of it is if you're a business, the bank thinks of a small business as at the low end of the scale that it wants to serve. If you then look at the loan demand for the small dollar business loan, it's a massive market. So you've got 120 billion of bank originations in this space at 100K or less. You've got another 46 billion taking you up to 166 of bank between 100 and 250K. We think there's another 100 billion at least of unmet demand, creating a total opportunity of $250 billion for smaller dollar loans to small businesses. So one of the key things to think about here is if in 2007 we wrote this business plan, before the Great Recession, why did we think that was a good opportunity at that time? It's because it's not a problem of credit and capital, it's a problem of time and cost. Banks are simply not set up well to make small dollar loans efficiently. Oliver Wyman did a study where they found that bank loans underneath $100,000 to small businesses are generally unprofitable. And when you have an unprofitable product, you're depending on attachments to other products to sort of build that per customer profitability up. If you were designing sales incentives at a bank and you knew that one of your products was unprofitable but the $1 million loan was profitable, think about how you design your sales incentives. You'd be incenting people for volume as opposed to actual numbers of loans that they generated. So the $40,000 loan has always been a challenge for the traditional banking system to deliver. Equifax did a study last year where they found that the average time to get a term loan in the US is about 30 days. So that just gives you a sense of the time and effort required on the part of business owners and on the part of banks, and neither side is happy. This is another problem. This is a very complicated slide. I bet people in the back row have absolutely no idea what this slide says. This slide came from a JP Morgan Chase board meeting where they were describing the amount of regulation that exists over banking products in the US. And what you can see is that on the lower part of the chart, you've got all these blue boxes that represent different lines of business on the bank. And then all the lines emanating up from those blue boxes are the various regulatory agencies that oversee that particular line of business for the bank. And so it becomes very, very challenging. Imagine you're in a very, very large company, you want to innovate, you want to deliver a new kind of product to your small business customer, but then you have to check in with a number of different regulatory agencies as well as navigate the internal processes at your bank to get something new and different approved. So, again, why is there a gap in small business lending? Part of it is regulation. Part of it is how efficient you need to be to make a $40,000 loan. And part of it is the economy at large, right? Lending is notoriously cyclical. And so in the Great Recession, there was a pullback from this segment that hasn't completely recovered. So what are some of the solutions? You guys are all here at LendIt, so I don't need to sell you this part of the story. Financial services is being disrupted, full stop. You look at some of the trends that have existed in retail or travel. Think about how you might have bought a plane ticket 20 years ago and how you buy a plane ticket today. You think about payments, what's happened there in the last 10 or 15 years. And lending is one of the last industries to be transformed. Lending is complicated, it's capital intensive, it's regulated. There's a credit dynamic. You don't know if you make money when you sell your product. You only know if you've made money when people pay it back, right? So it's one of those things that took a while, but now the core elements are there. The technology is there, the data infrastructure is there, and you are starting to see this industry be transformed by a lot of the companies that are presenting at this event. One of the key things about OnDeck's approach and why it's different is the way we analyze the creditworthiness of a small business owner. We knew when we started that the prevailing way that most people thought about businesses when they wanted to make loans of a certain size was that they boiled the business down to its owner. They took Noah's restaurant and made it all about Noah and Noah's FICO score. And the thing is, the FICO score really doesn't contain any information about what kind of business owner Noah is. I could be, if I'm running a restaurant, a great cook or a terrible cook. That is not reflected at all in my FICO score. All that matters in that score is whether I'm paying my bills, how many times I've sought credit in the last year, or what have you. It's all about negative personal information. So we set out to create a different kind of score. And $1 billion of loans later, we think we've done it. It's all about positive business information. The OnDeck score looks at a business as a business first and as a consumer second. So we look at things that actually relate to how well that business is doing. We look at data like cash flow, for example. How many transactions per month is this business processing? How volatile are the cash flows in this business? What are the aggregate levels of cash moving through the business? Is the business owner a good cash manager or a bad cash manager? We're looking at attributes of the business. What type of business is it? Where is it in the country? How long has it been operating? We look a lot at trade info. What types of credit has this business been able to access or not access before? And we look at some esoteric data sources too, public records, social data, especially to fill out the picture when some of these other pieces might be missing. The OnDeck score is now on its 4th generation, soon to be on its 5th generation. It's powered $1 billion in loans. It's going to power $1 billion of loans this year. We think it's a fundamentally different way of looking at the creditworthiness of a Main Street business. Behind that, we built a platform to lend. And here is the platform that essentially connects Wall Street to Main Street. On one side, you have capital sources. We handle capital from dozens of institutional capital sources today. We did a securitization last week. That was the first non-SBA securitization of business loans. Major milestone, we think, not only for OnDeck, but probably for the industry as well. So we brought on about 20 new institutional investors in that process. But really, for years behind that, we've had a number of institutions, whether it's hedge funds or banks or family offices, on the platform. All that stuff in the middle is built from scratch by us. It's processed 240,000 loan applications so far. We've processed millions of daily payments. OnDeck collects its loans daily because our businesses typically cash flow daily. And we have millions of variables in our small business database. For every application that comes in, we collect about 2,000 data points from both traditional and non-traditional sources to make our credit decision. So when we think about the way the company has evolved, we want to be the Apple of this industry. Completely vertically integrated. The origination, the servicing, the data aggregation, and the credit scoring, all in a single company. That's the sort of bet we're making, is that by being vertically integrated, we can deliver a differentiated product in the market and have something that stands apart from what traditional lenders have done vis-a-vis these small businesses. Why do business owners take these loans? It's typically around growth needs in the business. So you get your business off the ground, and you probably use personal credit or borrow from friends and family. You have something going, it's a year, 2 years, 3 years into it, and let's say you're a retailer and you have this opportunity, you want to buy some inventory. But you've already used your personal credit cards to kind of finance the initial operations of the business. So your FICO score might be a little bit lower than what it would have been had you not started this business. You want to buy inventory, you can buy inventory for $1 and sell it for $2 at retail within a few months. That's the perfect use of an OnDeck loan. So it's inventory, investing in marketing, remodeling, seasonal expansion. 38% of businesses hire workers, essentially, at some point in the year to handle seasonal spikes in demand. It could be equipment, for example. You're a bar and you want to serve food, so you buy an oven, for example, and you make more revenue from that oven. That payback is a relatively foreseeable thing. And what we were surprised about is how much this product resonated with businesses of all types and all maturities. So when we started the business, we sort of thought, the average business that can't get served well from a bank is probably going to be a couple of years in business and just emerging. It turns out OnDeck's average customer has been in business for 10 years. Pretty amazing. They do $1 million in annual revenue. They employ between 5 and 25 people. And their FICO scores are all over the place. 40% of our population has FICO scores above 700. So these are folks who are choosing us for a whole bunch of reasons, including speed and convenience, but they probably do have other options from credit cards or banks. For the rest of the population, we are opening up access to capital to a new segment of businesses who either couldn't get traditional bank loans or had very high-cost merchant cash advances as their prior alternative. One of the core tenets for us is we look for businesses that have a large number of small transactions. OnDeck does not provide capital to the general contractor that might build a house twice a year. OnDeck provides capital to the quick-serve restaurant or the masonry store that's serving that general contractor, but who's selling to hundreds or thousands of customers. So less than $75 is the average transaction size of the customer that we serve. And it's a very horizontal solution. Unlike some other solutions in this space that have gone after specific vertical markets like restaurants, for example, or even veterinarians is another one I'm aware of, this is all about analyzing business fundamentals at warp speed. So we look at things that any bank underwriter would look at, but we use an automated platform to do that. So we look at business credit, we look at cash flow, we look at all those variables I showed on the prior slide. And so the product we deliver goes anywhere from $5,000 up to $250,000. Our terms are anywhere from 3 to 24 months. Our collection is different than a traditional loan. One of the more important things we realized is that we wanted to separate the ability to pay from the willingness to pay with our customers. So we have automated collection that occurs either daily or weekly for our customers because, as to that other point, they're cash flowing daily, and if not daily, multiple times per week. The process is very fast and convenient. I mentioned it took 30 days on average to get a term loan from a traditional bank. If you're getting an SBA loan, typically that time is even much longer. On our website, we can deliver a $35,000 approval and loan funding in 10 minutes or less. We can deliver a $250,000 approval and funding in several hours. So the bottleneck in this process really is the borrower and how fast they want to move through the process, and they're not held up by the process on the lender's side. One of the other things we realize is that customer service and customer satisfaction is extremely important to this target. They've felt disrespected in many ways by banks. They're kind of amazed that they have massive deposit balances at a bank that they've gone to for 5 years, but then when they go into that bank to get a loan, they get denied. And then they have to see that banker regularly as they go back to the bank for other needs in their business. So we provide extended service hours, 12 hours a day, Monday through Saturday, where they can talk to folks on the phone at any stage of the process, before applying, during applying, after funding, what have you. And we have very, very high net promoter scores. We have a 67 NPS across all of our channels, right up there with Apple, Amazon, Southwest, and other great brands. And in some channels, that score is even higher. So it's a superior value proposition, we think, from a service perspective. And then when you add the access and the speed together, it's a winning combination. This is our growth. The key thing I want to temper folks with on this slide is you can grow a lending business at any rate you want if you approve all the wrong people for loans. So during this period, not only did our loans grow, but our credit quality improved. And what you can see here is a fairly geometric growth path where the first 4 or 5 years as we came out of the credit crisis, we were focused really on building the business, building the technology, building the scoring. But in the last couple of years, we've gotten very focused on distribution, building direct channels to market, building affiliate partnerships with companies like Intuit, and that's what you can see is really driving the outsized growth here. The other thing I'll mention is we have substantial repeat usage of the product. The biggest hurdle we're overcoming is trust. No one's heard of OnDeck, and there's nothing sketchier than some guy trying to sell you a loan on the internet. But once they get past that and they actually experience how easy it is to work with us, they come back. So 2.5 transactions per customer is the lifetime kind of average. that number keeps trending up as we build more of a track record and more of a history in the business. So you can see in the early part of 2014, we did about 225 million of loan originations. That number was up 180% from the same period a year prior. So from an investor's perspective, we think this is a new asset class, and we think the securitization transaction we announced last week really, is the hallmark or sort of the highlight of small business lending so far, because it really sort of says, these loans can be made investment grade, they can be structured and sold to investors of all different types, and OnDeck is truly a platform that connects investors to Main Street. So how can investors participate on the OnDeck platform? I think what's unique about us, as opposed to a lot of the companies in this conference, is whether you want to participate in a senior note structure, a sub-note structure, or actually hold the whole loan, or the equity risk, if you will, in any individual loan, we have all three options available. We've had senior lenders for many years on the banking side, but also hedge funds and family offices. We have the securitization transaction I mentioned. And something many people don't know about OnDeck is that we actually have a marketplace as well. We don't target retail investors. We target institutional investors who buy whole loans off of our platform, portfolios of them. And if you're interested in that, feel free to come up and talk to us after the conference or after this presentation. I think the key thing also to think about is there are many platforms at this conference that are just getting started making loans, especially in the small business space. And while a lot of the history in this space has been shorter term, higher rate lending, you have folks who are going out for longer terms and lower rates. And as an investor, the thing I'd be wondering is, how much experience do you have? What is your underwriting process? And why are you optimistic that this loan to this business will survive for 3, 4, 5 years when you don't have any pools of capital that have necessarily even completed their course? I think the nice thing from an investor's perspective about our platform is it's mature. At this point, we have 28 static pools of quarterly vintages now, and we can show you performance data on, call it, 24 of them. So there's a lot of track record to analyze, and as we engage with investors, we're very forthcoming about the data. And in the securitization, a lot of our data now is public domain anyway. So in summary, there's a gap in the small business lending market. We think it's between $5,000 and a quarter million. They've been historically underserved by banks for efficiency reasons, for regulatory reasons, for profitability reasons. Technology and big data are changing the game here. If you look at a business differently, you can make a different kind of decision. If you aggregate electronic performance data about a business, you can make that decision quickly. And if you use technology, you can build a business that scales very, very rapidly without adding a whole lot of people. Direct lending is moving towards mass market adoption. So while a couple years ago there was nothing sketchier than a guy offering you a loan on the internet, we can see right now this technology is crossing the chasm. We see it moving from early adopters to mainstream folks. Folks who might not have considered an online loan 2 or 3 years ago are now moving into the space, and conferences like this and all the different platforms are helping that transition happen. So we're pioneering a new asset class, the small business loan to Main Street, delivered with technology and new types of credit models. And we encourage all of you, if you're interested in learning more, to talk to us after the presentation. Thank you.